Europe confiscated $105 billion from Russia to finance Ukraine. Russia then took ownership of $120 billion in European corporate holdings within its borders, companies like Siemens, Volkswagen, and Shell. 3 decades of investment evaporated, and that was merely the first play. I aim to illustrate for you how Europe just executed one of the most disastrous strategic errors in recent economic memory. Not because the core intention was flawed, but because they deeply misjudged which side held greater vulnerability. They believed they were deploying a weapon of finance. In reality, they delivered to Russia a blueprint for dismantling European economic trust. And Russia didn't merely follow that blueprint, they refined it. Allow me to rewind to February 2024. Brussels was facing immense strain. The conflict in Ukraine was dragging through its 3rd year. Ukraine required funds. European citizens were growing weary of signing over checks. And within Brussels, someone conceived an idea that appeared brilliant. Russia has $105 billion in assets immobilized within European financial entities, central bank reserves, sovereign wealth fund holdings, investment accounts, all sitting idle. Why not take them? Use them to bankroll Ukraine, penalize Russia, and resolve the funding dilemma. No need for raising domestic taxes. The legal rationale was inventive to phrase it diplomatically. Freezing assets during wartime is customary. Actually confiscating them and transferring title that is unheard of for the sovereign reserves of a major economy. Yet European legal experts carved out a path. The declaration arrived in March 2024. $15 billion in Russian state assets would be seized and handed over to Ukraine for rebuilding. The initial response was victorious. European leaders hailed it as innovative economic strategy. Financial publications applauded the audacity. Ukraine rejoiced. The narrative was straightforward. Russia would finance its own war with money it couldn't protect. For roughly a fortnight, it seemed a stroke of genius. Then Moscow answered, not with furious declarations or diplomatic objections, but with 3 maneuvers so deliberate, so crushing that European finance ministers are still grappling with the impact. First move. Russia proclaimed the nationalization of all European corporate assets on Russian soil, not a suspension of activities, not a provisional seizure, but permanent state appropriation. The value $120 billion, exceeding what Europe had the 120B question, what assets were seized and why taken. Let me make this tangible because the human toll vanishes in aggregate figures. Volkswagen had been functioning in Russia since the 1990s. They constructed factories, established supply chains, trained employees, invested billions. In some Russian urban centers, VW facilities were the biggest employers. 30 years of patient investment, thousands of positions created, relationships forged, all of it vanished. The Russian government assumed control of the plants, the machinery, the intellectual property. Volkswagen's Russian subsidiary simply stopped existing as a German firm. Siemens met an identical destiny. They had installed electrical infrastructure throughout Russia, built railway networks, supplied industrial machinery. Russia didn't merely confiscate the physical assets. They took the maintenance agreements, the spare part stockpiles, the service contracts, decades of market presence erased in a day. Shell's situation was even more severe. They held significant stakes in Russian energy ventures. Sakhalin II, Arctic LNG, joint enterprises with Gazprom worth tens of billions. Russia nationalized every foreign share. Shell transitioned from an equity partner to owning nothing without obtaining a single ruble in reimbursement. And it wasn't only the giants. Hundreds of European firms from medium-sized producers to service providers found their Russian operations had been expropriated. Danone forfeited dairy facilities. Carlsberg lost breweries. Auchan surrendered retail stores. The catalog continued. Every European corporation that had invested in Russia over 30 years awoke to discover their assets now belonged to another entity. The immediate corporate damages were breathtaking. Yet the strategic repercussions were more severe because Russia did not let those assets live. They sold them to Chinese corporations at enormous markdowns. Ponder what that signifies. European companies devoted 30 years constructing market presence in Russia, comprehending local consumers, cultivating distribution channels, training personnel. That expertise, that market standing, it cannot be rapidly reconstructed. It embodies a competitive edge earned through decades of steadfast investment. Russia delivered all of it to Chinese rivals for a mere slice of its genuine worth. Volkswagen's Russian market share did not dissolve. It was transferred to Chinese automakers who purchased the factories and continued production. Shell's energy projects did not halt. They proceeded under Chinese ownership. Siemens contracts were not voided. Chinese industrial firms assumed them. Europe sacrificed 30 years of investment and market position. China acquired it within months, but Russia's counteraction did not conclude with nationalization. The second move was more nuanced, yet possibly more destructive in the long run. Russia declared that all energy exports, all commodity sales would henceforth be settled exclusively in rubles or yuan. No euros accepted. Full stop. Now you might presume this would legal and financial implications for Europe isolate Russia from global commerce. Europe presumed it would. The entire Western financial architecture operates on dollars and euros. If Russia rejected euros, surely its clients would decline to deal in rubles. Surely India, China, Turkey, the primary purchasers of Russian energy, would insist on conventional currency settlements. They did not refuse. They silently transitioned. India established ruble-rupee payment frameworks. China was already employing yuan for Russian dealings and expanded its use. Turkey forged comparable bilateral setups. Within months, Russia was executing the bulk of its international trade without touching euros. The practical consequence: Europe's economic sanctions, which relied on Russia requiring entry to euro-denominated finance, grew far less potent. The leverage dissolved. But the message to the world was even more profound. If Russia can trade with major economies without utilizing Western currencies, what does that indicate about dollar and euro supremacy? What does it signal regarding the indispensability of the Western financial system? The answer was growing unsettling. It is optional, perhaps not ideal, but absolutely optional for nations prepared to craft alternatives. Then arrived the third move, and this is the one depriving European central bankers of sleep. Russia, alongside BRICS allies, proclaimed the formation of a $150 billion BRICS Plus reserve fund. The stated purpose: to offer seizure-proof custody for member nations' reserves. Let me clarify why this is significant. Central banks retain foreign reserves for trade settlement and crisis management. Conventionally, those reserves are held in dollars and euros because they are liquid, stable, and universally accepted. But those reserves are housed within Western financial institutions. New York banks, London clearing houses, Frankfurt accounts, which implies they can be frozen or confiscated if Western governments elect to do so. Russia laid bare this fragility. One day your reserves are accessible, the next they are frozen. The day after that they are seized and gifted to another party. For any observing nation, the lesson was alarming. Your reserves belong to you only until a Western government decides they do not. The BRICS Plus Reserve Fund presents an alternative held outside Western legal reach, designed explicitly to be seizure-proof, not denominated in dollars or euros. For countries anxious about Western financial weaponization, it is precisely what they required. And within weeks of the announcement, dozens of nations discreetly commenced exploring involvement. Saudi Arabia inquired about membership, not because they are anti-Western, but because they possess $600 billion in reserves, and they just witnessed $15 billion being confiscated from another major oil exporter. If it could happen to Russia, why not to them? What if a future U.S. administration determines Saudi oil policy is not aligned with American interests? Could they awaken one morning to discover their reserves seized? Singapore, among the world's most advanced financial hubs, began posing sanctions, retaliation, and precedent in global politics identical questions. Their entire operational model relies on being a secure, neutral sanctuary for international capital. But if Western financial systems can seize sovereign reserves based on political rulings, is any location genuinely safe? They started diversifying. Even Switzerland, the archetypal neutral financial haven, confronted scrutiny. Swiss banks held some of the frozen Russian assets. The Swiss government engaged in the sanctions regime. For centuries, Switzerland's value proposition was absolute neutrality and discretion. That reputation suffered a blow. If Switzerland freezes Russian central bank reserves, what does Swiss neutrality signify? Capital outflow began almost instantly. Not dramatic sell-offs that grab headlines, but quiet portfolio recalibrations. Reserve managers in Riyadh, Abu Dhabi, Beijing, and Singapore began trimming euro allocations, not to zero, but perhaps from 20% of reserves to 15%, from 15% to 10%. Measured in percentages, it appears minor. Measured in absolute terms, we are discussing hundreds of billions migrating out of euro-denominated assets. When that scale of capital relocates, effects reverberate through the system. The euro weakened despite European central bank action. Borrowing expenses for EU governments rose as demand for their bonds waned. The gap between German bonds and U.S. treasuries expanded. These shifts are subtle, but they are consequential. They signify the gradual decay of the euro standing as a favored reserve currency. Let me link what Europe truly achieved with this 105 billion confiscation. They financed Ukraine for perhaps 1 year. That is the gain, the costs. European corporations lost $120 billion in tangible assets and 30 years of market position in Russia. The euro's credibility as a reserve currency was impaired. China obtained massive market share in Russia at discounted prices. Dozens of countries started actively pursuing alternatives to Western financial systems. The strategic assessment was calamitous. Europe assumed Russia needed access to European finance more than Europe required Russian cooperation and market access. They were mistaken. Russia possesses China. Russia possesses India. Russia possesses commodity exports that the world needs irrespective of currency. Europe possessed corporations with enormous sunk costs in Russia and a currency whose worth hinges on global confidence. And here is what renders this so aggravating from an economic perspective. The individuals making the choice were not foolish. They comprehended finance. They recognized the risks. Yet they made a political calculation that superseded economic rationale. The domestic politics of appearing to penalize Russia outweighed the long-term repercussions of weaponizing financial systems. Because once you weaponize finance a single time, every nation worldwide adapts its conduct. They do not trust your guarantees that it was an exceptional case. They do not believe you when you assert their reserves are secure. China's position, neutral observer or strategic winner witnessed what transpired with Russia and they prepare. This is not about justifying Russia's invasion of Ukraine. That is a distinct moral and political issue. This is about whether the instrument Europe employed was intelligent, whether the expenses justified the benefits. And the answer observing the economic aftermath is unequivocally no. I want to specify the corporate devastation because these companies possess names, histories, and people whose lives were altered. Volkswagen's Russian operations directly employed 15,000 individuals, including tens of thousands of jobs. Those Russian workers did not invade Ukraine. They assembled automobiles. When their German employer lost the company, they lost their positions or were transferred to Chinese ownership. The human cost of these economic weapons is not abstract. For Volkswagen shareholders, the write-down was enormous. For Volkswagen employees in Germany, it meant diminished profitability and potential job uncertainty at home. For Volkswagen's competitive stance globally, it meant surrendering a major market to Chinese rivals who now command the infrastructure VW constructed. Shell's predicament was arguably worse because energy assets demand decades to develop, locating reserves, negotiating terms, building extraction infrastructure. You cannot replace that swiftly. Shell did not merely forfeit revenue streams. They lost future production they had built business strategy around. And those reserves did not vanish. They are still being extracted just by Chinese corporations. Now the paradox is that this was entirely foreseeable. When you seize someone's assets, they seize yours. It is not complex strategy. It is elementary reciprocity. Yet, European decision-makers appeared authentically startled by Russia's reaction, as if they anticipated Russia to absorb $15 billion in losses without retribution. This exposes something disturbing about European strategic thought. They had grown so accustomed to engaging with nations that could not retaliate potently that they forgot what occurs when you confront someone who can strike back. Russia is not a minor economy reliant on Western favor. It is a major commodity exporter with influential allies. It possessed alternatives. Europe seemed to have forgotten that. The geopolitical realignment this activated is still evolving. The BRICS Plus Reserve Fund is not solely about reserves. It is about constructing parallel financial infrastructure beyond Western dominion. Payment networks, clearing mechanisms, credit facilities. Each piece of infrastructure diminishes reliance on Western systems. China emerged as the colossal victor in all of this. They gained corporate assets in Russia at discounts. They positioned the yuan as an alternative settlement currency. They spearhead the BRICS Plus initiatives that dozens of nations are now joining. The Belt and Road Initiative just received a tremendous boost because China can now present financial alternatives to countries concerned about Western sanctions. The timing could not be more inopportune for Europe. Europe is already grappling with energy costs following the Ukraine war. Industrial competitiveness is waning. Germany, Europe's economic motor, is confronting potential deindustrialization. And now atop all that, European companies just lost a massive market, and European finance lost credibility as a safe harbor. The lesson the world learned was not the one Europe intended to impart. Europe aimed to demonstrate de-dollarization and alternative financial systems that invading neighbors carries economic penalties. What the world actually learned was that holding reserves in Western financial systems exposes you to politically driven confiscation. Those are profoundly different lessons. Saudi Arabia is now negotiating oil sales in yuan. That was inconceivable 5 years ago. The petrodollar system wherein oil was globally priced in dollars was a cornerstone of dollar dominance. If oil transactions migrate to other currencies, dollar demand drops, dollar value falls, and U.S. borrowing costs climb. Europe's asset seizure did not merely harm the euro. It is contributing to the slow undermining of the entire Western financial architecture. The strategic blunder was not seizing Russian assets in itself. It was executing it without contemplating second-order effects, without inquiring what Russia would do in response, without modeling how other nations would react, without considering whether $15 billion in short-term funding was worth permanent harm to financial system credibility. This is economic policy propelled by political exigency rather than strategic reasoning, and the costs are being borne not by the politicians who made the decision, but by European companies, European workers, and European financial credibility. I do not know if a superior option existed for Europe in supporting Ukraine. Perhaps there was not. Perhaps every choice was poor, and this appeared the least bad politically. Yet if this was the optimal option, that reveals something troubling about Europe's strategic posture. That the best they could manage was to provoke massive corporate losses and financial system credibility damage for 1 year of Ukraine funding. The genuine tragedy is that this was not essential. Europe could have funded Ukraine through conventional budgetary mechanisms, tax hikes, spending reductions, bond issuance, all politically painful, but none would have triggered Russian retaliation or global erosion of confidence in European finance. They selected the path that seemed politically convenient in the near term, and it is costing them tremendously in the long term. Russia did not merely reply to Europe's economic warfare. They instructed a masterclass in it. And the lesson is not for Europe alone. It is for every nation watching. The epic of Western financial supremacy is not concluding due to Russian might. It is concluding because Western powers are demonstrating that the system cannot be trusted, and dozens of countries are deriving the evident conclusion. Build alternatives, diversify, reduce dependence. This is how empires conclude, not with spectacular collapse, but with steady erosion of the mechanisms that rendered them dominant. The $105 billion seizure will be examined for decades as a case study in strategic miscalculation. Europe believed they were punishing Russia. They were actually demolishing their own credibility. Let me demonstrate precisely how the alternative financial infrastructure is developing, because this is not theoretical future planning. This is occurring now. The SWIFT system, which manages international bank messaging and enables cross-border payments, has been the long-term impact on global markets and alliances' backbone of global finance for 50 years. Russia was partially disconnected from SWIFT in 2022. Initially, this appeared devastating. How do you conduct international trade without SWIFT? Russia had a solution prepared. SBFS, their domestic alternative, had been in development since 2014 when Crimea sanctions first threatened SWIFT access. By 2024, SBFS boasted over 500 participants, including banks from 20 countries. China's CIPS system, an alternative to SWIFT for UN transactions, integrated with SBFS. Suddenly, Russia and China could conduct trade entirely outside Western financial infrastructure. The volume of transactions on these alternative networks is increasing exponentially. In 2022, perhaps 10% of Russian international trade settled outside SWIFT. By late 2024, that figure surpassed 60%, and it is not solely Russia utilizing these alternatives. Turkish banks are connected. Indian banks are connected. Central Asian republics, Middle Eastern states, African nations are exploring links. Why does this matter beyond Russia? Because every country that links to alternative payment systems reduces its dependence on Western-controlled infrastructure. And that dependence was the source of Western financial power. If you require SWIFT to trade, you need Western approval. If you do not need SWIFT, Western approval becomes discretionary. The European Central Bank comprehends this menace. Internal documents reveal their modeling of scenarios where the euro forfeits 20 to 30% of its reserve currency share over the next decade. Less demand for euros implies lower value. Lower value means higher import expenses. Higher costs translate to inflation or reduced consumption. European living standards deteriorate, and there exists no simple policy countermeasure. Reserve currency status is not about interest rates or monetary policy. It is about trust. Europe fractured that trust. You cannot restore it with press releases. Let me detail how capital flight operates. You are a reserve manager for the Saudi Central Bank. $600 billion in reserves, 20% in euros. After observing Europe seize Russian reserves, you are uneasy. You do not sell everything immediately. As euro bonds reach maturity, you reinvest 80% in euros, shift 20% to gold or yuan, quiet, gradual, but multiply this across dozens of central banks and sovereign wealth funds. European bond auctions become less oversubscribed. The EU requires higher yields to attract purchasers. Higher yields mean higher borrowing expenses. Higher costs imply either increased taxes or curtailed spending. Growth decelerates. This is already observable. German bond yields relative to U.S. Treasuries have widened from nearly 0 to 50 basis points on Germany's $2 trillion debt that equates to billions in extra yearly interest costs. The corporate sector is drawing risks of escalation and global fragmentation conclusions as well. If investing in certain nations exposes them to nationalization risk stemming from European political decisions, perhaps those investments are not worthwhile. Shell publicly states they will never invest in Russia again, but they are also wary of China, Brazil, anywhere that might confront sanctions. This weariness translates to reduced investment, diminished future revenue, and lower shareholder returns. For European workers, this means employment insecurity. When employers forfeit major markets and grow cautious about expansion, growth slows, hiring stagnates, wages plateau. The geopolitical dimension is even more worrisome. Europe's strategy depended on economic coercion being effective. If that tool is impaired, what supplants it? Europe's military capability is limited and fragmented. Diplomatic pressure functions when reinforced by economic leverage. Without it, protests are disregarded. China is the sole unambiguous victor. Russian market share, the UN as an alternative currency, alternative financial infrastructure. And they demonstrated to the global South that partnership with China offers shelter from Western financial coercion. The Belt and Road Initiative just received renewed vitality. China can now offer nations not merely infrastructure investment, but financial independence from Western systems for countries that perceive Western conditions as overly intrusive. That is enticing. Russia's calculations throughout this were rational from their viewpoint. Yes, they lost $105 billion, but they exhibited strength, damaged Western credibility, hastened alternative system development, and imposed costs on European corporations that far surpassed their own losses. From a purely strategic standpoint, they won the exchange, and they are not finished. Russia has begun hinting at additional retaliatory steps if European nations seize more Russian assets. What those measures might be is unspecified, but the threat is clear. Europe unlocked a door to economic warfare whose consequences they cannot command. Some European policymakers are privately conceding the seizure was an error, not publicly for public admission would be political suicide. But in confidential sessions, they acknowledge the costs surpass the benefits. The dilemma is there is no way to revoke it. The assets are gone. The precedent is established. The harm is inflicted. The only question now is how far the erosion of euro credibility proceeds. In the best-case final verdict, who gains, who loses, and what comes next scenario, it stabilizes at a new lower plateau of trust. The euro remains a reserve currency, but a diminished one. In the worst-case scenario, this is the commencement of a spiral where dwindling confidence leads to capital flight, which leads to higher borrowing costs, which leads to economic frailty, which leads to further diminished confidence. The European Union was constructed on economic integration as a route to peace and prosperity. The irony is that weaponizing the very financial integration that was supposed to prevent conflict might end up annihilating the prosperity that rendered integration viable. If European economies falter because their financial systems lost credibility, the political strains that follow could endanger the Union itself. We are observing a real-time exhibition of why financial systems rely on credibility above all else. The euro is not backed by gold or commodities. It is backed by trust. Trust that European institutions will honor their commitments and safeguard your assets. When that trust is injured, everything else unravels. And Europe injured that trust for $15 billion and 1 year of Ukraine funding. Historians will retrospect on this instant as a pivot point, not because of what Europe did to Russia, but because of what Europe did to itself. And the lesson will not be lost on future generations studying how economic powers decline. They will witness a case study in strategic short-sightedness, in political convenience overriding long-term deliberation, in weaponizing systems you depend on for credibility. Russia educated Europe in economic warfare.